You see it all the time. A company announces a stock split, and suddenly everyone's talking about it. The market gets all excited. But here's the thing. If you look at the actual math, nothing of value has really changed. So what is going on here? Today, we're digging into one of the most fascinating puzzles in finance, the stock split paradox. All right, let me ask you a question. Say you've got a pizza, right? You cut it from 8 slices into 16. Do you magically have more pizza? No, of course not. You've just got smaller slices. It seems so obvious. And you think the exact same logic applies to stocks. So why on earth does the market so often act like you just conjured up a second pizza out of thin air? And that, right there, is the heart of the paradox. On one side, you have the cold, hard math. It's just a cosmetic change. Your total investment is worth exactly the same down to the penny. But then you look at reality. You look at decades of market history, and you see that companies that split their stock, well, they often see their value shoot up afterward. It's a real mystery, and it's one we're going to solve. Okay, so before we can really crack this case, we got to make sure we're all on the same page. Let's quickly break down what a stock split actually is, from a purely mechanical point of view. So, a forward stock split, that's the official term, is basically when a company decides to divide its existing shares into more shares. The really, really crucial part to remember here is that the price per share is cut by the exact same amount. So if they double the shares, they have the price. The company's total value, its market cap, it doesn't change one bit, not by a single cent. Let's make this super clear with some numbers. Imagine you own 100 shares of a stock, and it's trading at $200 a share. Your total stake is $20,000. Now the company does a simple 2-for-1 split. Boom. You now have 200 shares, but each one is only worth $100. What's your total value? Still $20,000. Now let's take a more aggressive example, a 10-for-1 split on a $1,000 stock. You go from having 100 shares to 1,000 shares, and the price plummets to $100. And the total value? Yep, still exactly the same. No new money was created here. And just so we have the full picture, there's also the opposite of this, which is called a reverse stock split. This is where a company kind of bundles its shares together to make the price go up. They usually do this when they're in trouble, like to avoid getting kicked off a major stock exchange. So even though the math is neutral here too, the market sees this as a massive, flashing red light. It screams desperation, not confidence. Okay, so we've established the math is basically a wash and a reverse split is a bad sign. But what about those forward splits? Well, this is where things get really interesting. When you look at the historical data, this is where the paradox just explodes into plain view. It brings us right back to our big question. If it's all just cosmetic, why does history seem to show that these companies get richer? The data is frankly pretty wild. I mean, just look at this. The difference in performance is absolutely staggering. Bank of America did this huge study, looking at data all the way back to 1980. They found that companies who split their stock returned an average of 25.4% in the next year. Compare that to the S&P 500's average of about 12%. That's more than double. This is not some tiny little blip. It's a massive outperformance. And hey, this isn't just some short-term sugar rush either. Another huge study looked at over 1,000 stock splits and found that even 3 years later, these stocks had beaten the market by over 12%. So the data is just screaming at us. Something very real is going on here, something that goes way beyond simple arithmetic. All right, so if the math doesn't explain it, what does? Well, it turns out the answer comes down to 2 really powerful forces: the signal the split sends about the company and the psychology of us, the people buying the stock.
Okay, so the main theory that experts point to is something called the signaling hypothesis, and it makes a lot of sense when you think about it. Who knows a company's future better than the insiders, the management team? Nobody. So when they decide to split the stock, they're sending a very strong, very credible message to Wall Street. They're essentially saying, we are so confident that our business is about to crush it that we know this new, lower stock price is going to climb right back up. A struggling company? No way they'd risk that.
And you know what? The size of the split is part of the signal. A normal 2-for-1 split, that's a good sign of confidence. But a huge 10-for-1 split, like the ones we've seen from absolute giants like NVIDIA, wow, that's not just a signal, that's a statement of profound long-term confidence.
But it's not just about the message the company is sending. Stock splits also mess with our brains in some really interesting ways. They tap right into our human psychology and can trigger these biases that just make us want to buy.
There are 3 big ones we should talk about. First up is anchoring bias. Our brains get stuck on that old high price, so when the price suddenly drops to something lower, it just feels like a bargain, even if nothing fundamentally changed. Then there's the availability heuristic. A stock split is big news. It's all over financial media, so the company is suddenly top of mind for everybody. And finally, there's the representative heuristic. We see a stock split, and our brain immediately jumps to the legendary success stories. Apple, Amazon, Nvidia, and we just assume, hey, this company must be on that same amazing path.
Okay, let's bring this all home. We've looked at the math, the data, the signaling, the psychology. So, what's the real answer to our pizza paradox? Where does the wealth actually come from? This is probably the single most important takeaway. The split itself doesn't create any value. Not a single dollar. What it does is shine a massive, brilliant spotlight on the fundamental strength that's already there. Think about it. Why does a company's stock get so expensive that it needs to be split in the first place? It's because the business is already winning. They're innovating, they're growing, they're dominating their market. The true wealth is being created by that incredible performance. The split? That's just the beacon, the flare that goes up, drawing everyone's attention to a success story that was already happening. So that leaves us with one final thought. The next time you see that headline, Megacorp announces stock split, what are you going to see? Will you just see it as a financial trick, some mathematical sleight of hand? Or will you see it for what the data tells us it really is? A clue, a signpost, pointing you toward a business that is probably doing something very, very right.